Commit to Wealth Nation, welcome to the Commit to Wealth podcast. I'm your host, Juan Vargas. Today on the show, we have Andrew Campbell. Andrew is a multifamily syndicator based out of Austin, Texas. He's the co-founder of Wildhorn Capital, which controls over 1,100 units worth over $100 million spread throughout Central Texas. So, Andrew, welcome to the show.
Hey, Juan, thanks for having me. How are you?
Doing pretty good. It's an honor to have you here on the show. So let's go ahead and get right into this. So Andrew, I'll just briefly introduce you. So let's kind of talk about your background, where you calling us from today, and tell us about your background.
Sure. Well, you mentioned I grew up in Austin, Texas. That's where I live today. I've got 3 young kids and moved back to Austin in 2007. My dad had some health issues. I went to UT, moved out of state, was kind of working a corporate job. Moved back here when my dad had some health issues, and that was kind of the pivotal moment for me that sort of launched me into wanting to create passive income, to have financial independence, and really kind of launched me into real estate. So it was about that time started reading Rich Dad Poor Dad and kind of checking out different 4-Hour Work Week and just some of the big seminal books that people talk about, and you're really just looking for what I wanted to go do in our future. And that kind of launched us into buying a duplex. We funded a couple of fix and flips. We invested in some development deals, but I knew we wanted to go do something in real estate. And after kind of experimenting a little bit, realized that rental property was the way to go. So we built up a portfolio in Austin of about 75 units between my brother and I, and cut our teeth, managed the properties ourselves, kind of managed the renovations, did the whole sort of soup to nuts thing, and really saw it work, and saw that the cash flow came in on a monthly basis, which was awesome, and saw appreciation happening, and saw that the notes going down on our mortgages, and realized okay, this is the path. It's a lot of fun. We enjoyed the renovation process, kind of adding value to the properties, but also to the residents' lives. And but we also learned that it was really difficult to scale that business, and really difficult to scale 4 units at a time, and that that the bigger properties were more efficient. So kind of made the decision to go outside of our own capital, start raising money from other folks, partnering with them, and doing the larger deals. And so that's what we've been focused on at Wildhorn for the last 2 or 3 years.
Sweet. So I mean, you got your start pretty. I mean, it's nothing too crazy. I know that you invested passively, and you did smaller deals. So that's good. Let's kind of talk about today. That's kind of where the meat and potatoes of the interview is going to be. So let's kind of talk about today. Sure. So you are a co-founder in Wildhorn Capital. So let's talk about your role in that company.
Sure. So it's myself and my business partner Reed. We came together a couple of years ago, when we were both actively looking for deals and had been general partners in some deals. And both we met up and had started talking, just similar to this. So he has a podcast, went on there and just kept in touch, and realized that we had very complementary skill sets. So I'm local here in Austin. I've got an advertising degree, and then I got an MBA, but I'm very kind of marketing oriented. So I'm thinking about things from a qualitative perspective, I've done a communications perspective. He's a structural engineer. So he's done a bunch of ground up multifamily and has just an engineer's way of thinking about things. So we kind of split our role at Wildhorn along those lines. Mm-hmm. My job is to make sure that we're seeing all the deals, on market, off market, pocket listing, direct from owners, you name it, in our target markets of Austin, Houston, San Antonio. Again, kind of leveraging relationships and the fact that I grew up here and have those relationships. And then I also focus on the investor relations, so from an equity standpoint, as we get a deal under contract, making sure that we have the equity in place, and then kind of interfacing directly with the investors. And then Reed kind of runs more of the asset management, kind of the operational side. Again, leveraging his background in ground up construction. He manages the renovation process, the GC relationship. He kind of handles more of the underwriting with our analysts. And it kind of creates a nice mashup of sort of the art and the science of the business, as we kind of continue to do deals.
Sweet. So you mentioned that, you're basically in Central Texas, you're in Austin. You're looking in San Antonio, Houston as well. So apart from the geographical benefit that it gives you, because they're pretty close, what are some of the main reasons why you're choosing these markets?
Yeah, well, the geography is a big piece of it, and I think we're lucky that I'm here. That's where I'm from, so I know the area really well. We've looked out of state and I spent a bunch of time in Atlanta earlier this year, and just realized it's really hard to do it remote. Really went out there 5 times or so, and it's difficult to sort of create those relationships from afar, to give the attention to the relationships. I'm a big golfer, and I think we've built some really good relationships just being on the golf course with brokers and being able to pop in for coffee. And that's difficult, when you're only in town for 36 hours or 48 hours and you're trying to bang out a bunch of meetings. So geography's got a big role in that. And then I think, we've been fortunate that the Texas and the big Texas markets are obviously all growing, all, good places to live. And everybody sees the sort of the demographic trends, population growth, job growth, companies moving here, there's tax benefits, the weather's nice, et cetera, et cetera. So that's not a big secret. And I think we've benefited just from being, located here where people are coming to. And then leveraging the fact that we are local and that we can, build quality relationships. I think one thing that we've definitely sort of put a line in the sand around, though, is very focused on the big cities, not a group that's kind of looking at some of the tertiary markets where a lot of folks are going looking for yield. And I think there's some good opportunities, but for us, staying disciplined and focused and really wanting to find deals that are in infill locations in these primary markets that, are always going to have demand.
Yeah, especially if we do come across some kind of softening in the market. I think being in the right location, being in a good location where you attract some good quality tenants is key. To kind of withstand a little bit of softening, no matter where we go. So you mentioned Atlanta. Why were you looking at Atlanta? When you have these few markets here that are local, that are gigantic, and they're right there next to you. So why Atlanta?
We want to have diversity in our portfolio, diversification for our investors. And the thought was, let's get something outside of Texas, and did big analysis, kind of looked at, again, all the major markets and felt like Atlanta had a lot of similarities to what we've seen in Texas. But again, I think as we got out there, we weren't seeing better deals there than we were seeing here, in any of the markets that we're looking in. And it was more work, the 2.5 hour flight versus a 2.5 hour drive. Just kind of that relationship piece that we talked about. But I mean, we did a big sort of canvas of the country, and, Atlanta is and has been, I think will continue to be a good market. It just wasn't better than our own backyard.
Gotcha. So you were based in Austin again, we just mentioned that, but, there's a lot of investors that are not necessarily looking in Austin. They're not finding the same type of returns and same type of yield, and I know that your latest acquisition, which I guess we can bring it up here, it's in Austin. So what made you, what did you find in this deal in particular that you liked, and why did it stand out to you?
Yeah, well, I think, in general, people say, not looking in Austin. I mean, I think we've certainly been looking in Austin. I think it's a fantastic market. It's always at the top of, best places to live, fastest growing cities, et cetera, et cetera. I think a lot of that has driven the prices up quite a bit. And it's a sort of a sexy place, from an institutional equity standpoint. Everybody feels safe and kind of likes to tell their friends and, that, hey, I got a deal in Austin. It's a fun place to visit. It's got all that going for it, but it's made it very, very competitive to find deals. Cap rates are lower than some of the other cities in Texas. So I think it makes it more difficult, that this specific deal, it just came down to, having a really good relationship. We know the seller and we know the broker. It was an off-market deal that had been under contract with another group. It fell out, and they called us and said, "Hey, you should take a look at this." And we knew the owner, and we were able to kind of talk to them a little bit, and it made sense. But I think that was all driven by the fact it wasn't a super competitive marketed process. We were able to kind of take a couple of weeks, run our numbers, tour the property, kind of really evaluate, hey, this is where it's going to work for us. And we're really excited about it, but it's definitely, I think the fact that it was off market was a big part of the reason why it worked, and it didn't get, bid up and get real frothy.
Yeah, that's key. Definitely. So talk briefly, about that property, a little bit more. So, what was the size of it, like acquisition price and, those kind of things?
Sure. It's a pretty good size deal. It's 284 units. It's a newer deal, 2002. So we talked about one of our criteria being, infill locations in these primary markets in Texas. The other one is there's got to be a value add story. And, for us, that's kind of, 1980 to 2005 construction. I think any more new than 2005, you really got to question how much value add really exists. And do you need to come and do work? But this has a proven value add story. They've done a handful of renovations. So there's a lot of meat left on the bone, but as a newer property, there's not much deferred maintenance. There's not things we're going to have to go spend a lot of dollars on to fix and cure. It's just, buying a good sort of B+ to A- asset, do some interior renovations, some splash of color, update the clubhouse a little bit, and then just, watch Austin continue to grow, watch the rents grow, and hit our interior renovation plan.
Got it. So your business plan in general, you're not looking for deep value adds, right? You're doing more of a hybrid model where it's cash flowing already, and there's some value add component to the properties, correct?
Yeah. I think for us, that's been the best model. I think we've learned. We've certainly looked at some rougher C type deals, and it's not who we are. It's not our personality. I think it also is a good mix of where we are kind of a B- to an A- product is a very good adjusted return. There's less risk. It's a nicer deal. Tenant base is a little bit better jobs. We're not having to re-tenant a property, take it to zero, occupancy, kick everybody out, and you can get some phenomenal returns. And I know guys that are doing really well with that business model. There's more risk in that, and for us, this has been a good mix of buy something that's relatively stable, but has some upside. And we know there's a plan to go force the appreciation, but there's cash flow from day one. And we're just going to go improve upon that over the first 18 months to 2 years as we input our renovation plan.
Got it. So San Antonio is another market that you have some properties in. So let's kind of jump into San Antonio a little bit and talk about that market a little bit and why you find that market is still attractive as well.
Yeah, well, again, I think it comes back to population and job growth, and it certainly has those. It's not on the national radar, from a sort of super sexy standpoint like Austin is. But it's what I think it's the 11th biggest city in the country. So it's over 2.5 million people. So it's a massive city. It's got a growing and diversifying job base. It's not like lots of different industries. Again, it's close. I mean, I can be down to our properties in 90 minutes, from my house. So I can, get down there on a Wednesday and get back home in time for dinner with my kids, which is nice. But it's a different market than Austin. It's a different market than Houston. It's a little bit more, there's kind of peaks and valleys, and in the summer it gets really active and it slows down some in the fall and the winter. But again, the big drivers, it's seen good, steady population growth, good, steady rent growth. And it's been consistent, again, not super sexy, but very, very consistent.
Yeah. Okay. Yeah, I agree with you on those points as well. So let's jump into Houston, and we're kind of just doing a little, tour of each one of these, different cities, but let's do Houston now. Talk about why Houston is attractive to you as well. And I'm based here in Houston as well. And, there's some good opportunity, but I think for a lot of guys, getting into this market, it could be a little bit tough to break into. Maybe not like in Austin, but it could be a little bit tougher as well. So let's kind of jump into Houston, why it's attractive to you as well.
Yeah, well, I think it's got some similar story to San Antonio. If you compare sort of Houston and Dallas, they're always, the two biggest cities in Texas. Obviously, it's like a rivalry between the two. And I always tell people, like, I grew up in Austin, but even here, you sort of pick, are you a Houston guy or a Dallas guy? You just like, there's a, sports teams, the whole deal. You got to pick it, right? I know how
it is, yeah.
Dallas is super popular, right? From an investment standpoint, everybody's going there. It's had this phenomenal run. Houston is they had the hurricane. They've got, everybody's saying, oh, it's oil town. It's boom or bust based on the oil and the storm. And I think because of that, there's less, it doesn't have the sizzle of Dallas. And we like that, you can go in there and it's certainly competitive and there's a lot of capital flowing in through, but it's a massive city. It's the third, fourth largest city in the country. It's much more diversified than people think about from a industry standpoint. It's not just oil. It's not going anywhere. It continues to grow. And I think the other part is to your point, it's a little bit tougher to figure out, right? The zoning kind of their pockets, it's very pockety as you sort of move throughout the state. It's not like you can just, in San Antonio, you can say, hey, by north, north is good. South, it gets a little rougher. Houston's not that way, as you know, right? It's here, but half a mile over, you don't want to be there, but a half mile up, that's where you want to be.
Yeah.
It takes a little bit more time, energy, and effort to understand it. And I think for us that because again, we're relatively local and are down there and have relationships there, I feel like it's a place that we can get a competitive advantage and have more success than a Dallas at this point.
Got it. That's good. That's good. So let's kind of talk about, let's switch gears a little bit here and let's talk about how you are structuring your deals with your passives, right? So,
yeah.
What does a typical structure look like on one of your deals?
Sure. So they all have a very similar structure. And I think the biggest thing that we try to do and make sure we are doing is, number one, keep it simple. And number two is make sure we've got alignment of interest. And we talk about that, with our investors, like if they're successful, we're going to be successful. So our structure is very simple. We have a preferred return between 6 and 8%. The last couple of deals have been a 7% preferred return. And then we have a 70-30 split above that. We don't have any waterfalls. We don't have any other hurdles. It's meant to look, if investors are successful, we're going to be successful. Frankly, we want to be doing this for a long time. We view this very much as a long-term business. And the more money our investors make, the happier they're going to be. They're going to come back for us, for a lot in the future. And then just keeping it easy, sitting down and explaining to somebody this waterfall structure and, hey, once we get a 15, we're going to move it to a 60-40, and then it's going to be a 50-50. And also start to question motivations, all right, are we going to go do a refinance to boost the IRR that maybe puts undue risk on the property, but gets us into a better split? It's not been our sort of MO. So, keep it simple, 70-30 split above a pref, and that stays the whole way through.
Yeah. And I like that, you have to keep it simple. For most guys out there, they can't wrap their heads around what a waterfall is. They don't understand how it works. And so if somebody doesn't really understand, then, they're not going to, a lot of times they're not going to move forward, so
yeah.
Keeping it simple, prefer to return, in the front end and having it, a easy split, all the way through. It's always a better way. So you have a bunch of investors, so,
Mm-hmm.
in your deals, how much have you raised, throughout your portfolio?
We are approaching 50 million. So we've been, really fortunate. We've got great investors, great partners. So it's like 44 million, something like that when this deal closes in the last, I guess that's been in the last, just 13 months or so.
Yeah, no, that's a crazy number in that short period of time. So let's kind of talk about, your capital raising tips. What are you doing, and, how can you, best prepare to be able to raise capital, in such large amount as well in such a short period of time?
Yeah, I mean, it really comes back to relationships.
Mm-hmm.
And I think that's something that we focus on, very intently, and spend a lot of time and energy doing. So doing, interviews like this and kind of getting our name out there and trying to bring value and add value to people, but be authentic. We are our sort of articles and the blogs that we write always are try to be very transparent, very authentic. I've got a personal goal of meeting 5 people every week, whether that's face to face or on the phone, like 5 new people. It's a constant conversation. It's a constant outreach, just talking to new people, letting them know what we're doing, seeing if people are interested. And then, having and building, good, honest, quality relationships. I mean, there's no question the majority of our investors, I'm in Austin, Reed's in LA. Like that's, if you sort of scatter plot our investors, there's the biggest concentration around where we are because we're local and we have those face-to-face relationships. Now we have investors, from all over, but, make sure we follow up, making sure, we're checking in, and it's not just, hey, when we have a deal. We do pride ourselves on our investor communications. I had a guy recently, actually, he's an investor that actually lives in Houston, but he called me a couple of weeks ago and gave me a great compliment. He's an older guy, so he's invested in 100 different LP deals in his life. All
Mm-hmm.
sorts of hotels and oil deals and all sorts of stuff. And he said, "You guys have the best investor communications that I've ever seen. And I forward your communications to my other operating partners. Like, this is what it means to be a good communicator." And I was like, that was number one, a super awesome compliment. But it was also really like gratifying and say, hey, we got to double down and continue to do that, because I think that's been a big key to helping us, be successful and communicate. And it's fun. I mean, I enjoy talking to people. I enjoy building relationships. I enjoy, telling people about what we're doing. I mean, it's not our project. It's our project. Our investors are owners in this deal. And so, as we're talking to them through deals, it's, here's what's going on. Here's the good, the bad, and the ugly, and just in a general sense, being out there and talking to people and being passionate about what you're talking about. People can feel your energy. They can tell when you're into it and when you're excited about it. And I think all that rubs off and adds up.
Yes, no, those are some great points, man. Communication is key, and, for any LP out there, and I'm an LP as well in some deals, that's one thing that really stands out, and I can see the communication from, these groups versus this group, so it really does make a difference. It makes all the difference, actually. So that is some good stuff. So let's talk about today's market. Obviously, we kind of touched on this, just earlier, but, we don't know where we're at in the cycle, and you can say what you want about the market and where it's going to go. But you're continuing to buy deals. You are still buying deals. So where are you seeing? Obviously, you're still, bullish on it, but kind of talk about that as well.
Yeah, I mean, it's been a phenomenal run. The market is appreciated a ton. Rents have grown a ton. At the end of the day, you look at as an asset class. Why do I like multifamily? Why do I think our investors like it? I always joke that I saw a study recently that said when given the choice, people want to live underneath a roof. I mean, it's a joke, but
yeah,
people want a place to live. They want a nice quality place to live. And I think, with our focus on kind of, relatively class B product that we're making nicer, we are providing that. And our price is going to continue to go up as much as they have. Our cap rate's going to go up. Our interest rate's going to go up. Probably, potentially, who knows? The market's been super interesting in the last 30 days, just as there's been some pushback and, the stock market's sporadic and schizophrenic. But it's a safe investment, compared to there's a hard asset backing it. Again, we know what we're buying going, and there's cash flow. I mean, when we look at our sensitivity analysis on these deals, it shows that, hey, if we're 80% occupied for this is a stat of our new Austin deal, but all of them are around these numbers. If you're 80% occupied for an extended period of time, for 3 years in a row, there's still a positive return. It's 3 or 4%. It's not what we want or what we're projecting, but that is still, we're not talking about doing capital calls. You're not talking about losing your principal, as an investor. We are still operating this thing positive cash flow standpoint. And that's at 80%. If you look at the numbers from the 2007, 2008, 2009, the last correction in Austin and San Antonio, the occupancy in 2009 was like 88%. And it lasted for about 12 to 18 months. So, again, just from a wealth preservation, capital preservation, safety, and what's an investment look like, I think this is the best asset class I've seen. The best investment that where I put my personal capital, and I think that's kind of the message that we talk about with our investors as well. Is we're talking about 15% returns, on an IRR basis. 8.5% cash on cash. Like, those are phenomenal. Like, well, if the market's terrible, and we don't hit our numbers, we're still talking about a 10% return, an 8% return. If we're hitting an 8% return on this deal, the overall economy is not doing well. The stock market is not doing well. It's a very safe asset class, because again, people need to move somewhere, and they want to live somewhere. And if you look at your renter population, if people haven't been buying homes in the last several years, with interest rates, sort of an all-time low, if interest rates tick up, they're not going to go flock to buy homes. They're going to continue to be renters. Then you throw in all the sort of millennial and, changes in attitude and preference about home ownership in general. I mean, it's a good place. And that's why we really focus on being in infill locations in these growing cities in Texas where, people are moving, and there will be demand for, even in a downturn.
Yeah. So that's what it's about. It's about stress testing the asset, the market, kind of seeing, going back, where it was at worst, And if you're still positive, then why not? Chances are we're not going to get that bad either. I don't see it, getting as bad as it was, back in 08, 09. It'll be a little bit of softening, but you'll still be in the 90s, somewhere in the 90s. So that is some good stuff. So apart from that, you mentioned earlier investor communication and your underwriting. So what kind of separates Wildhorn versus other multifamily investment firms? What is it that stands out with you guys?
I obviously like to think it's relationships. I like to think it's communication. We are a lean shop. I mean, when you talk to Wildhorn, you talk to Reed and myself. We've got some analysts, we've got some help, but we're active day to day. In our social media, we use a hashtag hands-on management. He and I are the ones making the decisions, making the calls, visiting the properties. Deciding paint colors. We're maybe too involved in some sense, but we enjoy it. I mean, I really like walking onto a property and saying, I'm leaving here to go meet our designer at the new property. And like, okay, here's our vision. We're going to convert this basketball court into the gym and make the gym a clubhouse. Let's talk that through. I love that. I don't want to stop. I'll never stop doing that because it's fun. So I think that's something else that comes through is we're passionate about the business, but we're super involved, engaged. Like these are personal deals to us. Everybody's always a common investor question. Well, how much money are you putting into the deal? How much skin do you have in the game? And we invest in all of our deals. I have so much skin in this game. Like I have all my skin in this game. Like this is what I live, breathe, and eat. And I'm not getting paid until you get paid. But I also just fundamentally love renovating a property, walking on and having that vision and then the satisfaction of being able to execute it. I mean, we're working 60, 80 hours a week on these things and it's fun. And I think that comes through. I hope that comes through, when we're talking to our investors and we're talking with new potential partners that they can tell these guys get it. I think they're smart, but they also, more than anything, they're honest, trustworthy, and passionate about it. And I think that's been, key.
Yeah, no, those are some great answers. I love that. That's what it's about. If you love what you do, then it's not really working. You've heard that many, many times over, but it really is true. Yeah. So that's no different here.
The very middle of my vision board. Sorry to interrupt you. I've got what you love what you do. And it's right in the middle, right here to the right of my desk. Look at it all the time. I think it is. It's not work. It's fun.
Yeah, and you've been doing it for a good while as well. So. It's just something that you kind of get into a routine. It becomes something that, you get up and you live and breathe it, every single day and just part of who you are, becomes, part of the person, so I love that. That's some good stuff. So Andrew, it's time for our Nuggets of Wealth. And these are questions that I ask every guest every week, and hopefully they are able to help out our audience. So question number one, what is a good tool, source, or platform that you use almost every day that can also help others?
Oh my gosh, there's so many of them. When you think about, technology. I mean, Google Drive kind of runs our business. I mean, that's probably an easy cop-out answer. Little other tricks. I love Calendly and the ability for people to kind of see create an appointment. I think that's always key. Kind of cuts down some of the back and forth and when you want to meet. I mean, technology in general. It's so pervasive, but I think it also allows two guys, Reed myself, to manage, $100 million portfolio. We do it with technology. We do it virtually. He's in LA, our assistants are spread out. We use Slack. I mean, technology is everything.
Yeah, no, I agree. Those are some, Google Drive. I mean, who doesn't use that anymore? I mean, yeah. Dropbox, that's something similar. Slack is something that's becoming very common and not many people, I guess, know about it, but it's something that's very common and, we use it as well. So it's
MailChimp. We've been talking a lot about investor communications and how do we communicate. MailChimp, having different lists and being able to kind of send out your communications, get that platform. That's key. I mean, you could go on and on. It's all technology.
Technology in general, yeah. And that's again, that's your platform, your blogs, your social media, everything is technology. Yeah. So, what was the best business advice you ever received?
Follow your dreams, follow your passion. I think what I've always, growing up, watched my dad. He was really successful finance guy. He hated his job. He absolutely hated his business partner, his job. It just was like, come home every night and he's just grumpy, right? I mean, he was a great dad, good guy, but he didn't love what he did. So, I followed my dream. I went and got an advertising degree. I was like, that's fun. Like, that is creative and energizing and fun. Moved into real estate. I wanted to do something that was fun. And here I am, with this portfolio, because it's what our dream is. So I think it's, follow your dreams and dream big and chase them, don't settle.
Yeah. And I would add to that. I mean, if you are, if you really do kind of, enjoy, at least, kind of enjoy your W-2 or your 9 to 5, if you're doing okay financially, then you don't have to leave it. You can still invest passively. And, why not you create another source of income, passive income, so I would say that, it doesn't have to be actively investing. It could be passively. So, what book are you currently reading?
Book I'm currently reading. I'm not currently reading a book. I'm kind of in between books, and I'm trying to catch up on podcasts. I think when I get in to read a book, then you get way behind on podcasts. I'm currently catching up on podcasts.
I'm with you on that. I mean, I have a bunch of different podcasts that I listen to as well, and then I have my books. So I have both book version, hard copy, and then the Audible. So I'm like, I shuffle between them or among them, and I'm like, if you focus too much on one, then you kind of ignore the other words. So it can be tough. It can be a little tough. So that's good. What is the best strategy that you use to manage your time?
I do weekly planning. So every Sunday I come in and come into the office, kind of write down, what are the 3 strategic goals for the week? What are and then day by day, what are the things I need to get done that day? And it's not a blocking out time on my calendar, but it's just sort of keeps me accountable for, hey, did I get these things done today? These are the key things. I just use a blank sheet of paper. I don't have a crazy journal format or anything. It's just, here's a sheet of notebook paper for the week and what's on it. I think that really helps me budget my time. And I think one thing that I really do during that time is I'm not just thinking about work. I'm thinking about, we talk a bunch about like life by design is a thing I always talk about. And so I'm looking at, kids' calendars and, I've got a person who I want to play golf once a week. And there's always some sort of like business element to that with a broker, an investor or partner or somebody. But when am I going to get that in this week? So really kind of scheduling what does life look like this week, and sort of that integration and blending of the work stuff as well as the personal and fun stuff. But sitting down and taking 30, 45 minutes to be intentional about the coming week, I've found to be really, really important. And if I don't do it, man, I start Monday and I'm like, what am I doing?
Yeah, no, I get it. And so this is the one place where you don't use technology, huh? It's just a piece of paper and a pen, huh?
Piece of paper. And it comes with me all week. I fold it up. I keep it in my red notebook, or like yesterday I left and I took a picture of Tuesday. It's like, okay, let's make sure I don't forget, what I got to get done today. Cause I had a bunch of appointments out running around. So yeah, I write it down. Cause I also find like, I don't turn my computer on Sunday when I'm doing it. I'll look at my calendar just on my phone, kind of what's happening, mm-hmm. But I really want to be thoughtful about, writing it down and just like, don't get online. Don't start doing emails. Like, no, this is separate from that, and writing it out. I think it's helped me stay focused on it.
There you go. Where do you see your business and company in the next 5 years?
Doing what we're doing. We're going to be doing this forever. We love it. And our plan is to continue to be able to, find and locate good deals and execute on them. We're going to continue to do kind of deals one at a time. And we tell people that we've got a goal of, we want the ability to execute 4 to 5 deals per year, and so that means we've got the operational systems in places, the relationships with property managers and general contractors, et cetera. And we'll bring in the people that we need to help do that, and also then the equity. But we don't have a gun to our head. We're not tied to, hey, we've got to go do 4 deals, or it's not a good year. We want the ability to execute and find those deals, and if we do that every year, we'll continue to grow. But we'll 5 years from now. I also tell people 5 years ago, I never have told you I'd have, $100 million portfolio. We'd have 1,100 units that I'd be syndicating these, $20, $30 million deals. Mm-hmm. My plan at that point was to continue to build out my rental portfolio and to get, 100 units and be done. Completely changed goals in 5 years as I got into the business and figured out I loved it. But I know that we'll still be doing this, but I don't know what the future holds.
Yeah. I mean, you're going to keep pushing. You're going to keep pushing, and wherever you're at in 5 years, that's where you're going to be. But you're not going to stop. Yeah. So that's good.
Yeah.
So one last question. At the end of your life, how do you want to be remembered?
As somebody that followed my dreams, as somebody that had a good quality, good balance in life. I think that's one thing that again, kind of back to life by design. When I look at, the relationship that I've got with my kids, we've got a 4-month-old right now, and we've got 7, 5, and 4 months. But being able to see them, throughout the day, to spend more time with them, and just have that sort of balance of, I've got flexibility in my schedule, and I can work from home when I want, or I'm out, doing on the road, meet with people, that I followed my dreams, and a big part of my dream is to have that life by design, work-life balance.
There you go. There you go. I love the answer. So this is really the last one. Where can come into Wealth Nation, go to contact you and find out more about your company and more about you as well?
Sure. Wildhorn Capital is the name of the company. Our website's wildhorncap.com. My email is andrew@wildhorncap.com. We've got a Facebook page. We're on Bigger Pockets as well. Kind of any of those channels.
Sweet. Okay. Well, Andrew, it was a great honor to have you on. You provided us a ton of value and a ton of good information, specifically, here in the Texas markets. And, we kind of dove into your business and your firm as well. So I appreciate you being on the show, and I wish you continued success.
Thanks. No, this has been a lot of fun. And, likewise, I look forward to connecting when we're down in Houston and partner on some deals with you, and keep doing what you're doing. The podcast's awesome.
Yes, sir. Thank you so much.
Thanks.